In this video, we're going to learn about tax-free savings accounts and registered retirement savings plans. Ensure you've watched the intro video on registered plans before watching this video. Tax-free savings account, as the name suggests, your earnings are tax-free. It's like a prepaid account. When you earn income from your employer, you pay tax on it, you invest it in the TFSA, and you never pay tax again. However, unlike what the name suggests, a TFSA is not limited to a savings account. As with other registered plans, you can invest in a savings account, but you can also buy GICs, stocks, bonds, mutual funds. Currently, the limit is $7,000 and carries forward. You begin accumulating limit the year you turn 18. If you withdraw any money from your TFSA, it adds to your limit the following year. So if you withdrew money from it in 2025, you would increase your limit for 2026. TFSA is ideal for short-term or long-term use. It is especially good for those who are currently earning a lower income. So, for example, if you were a student and you expect your income to increase in the future. So you're paying the tax up front on your earnings and you never pay tax again in the future when you would be in a higher tax bracket. Uses for a TFSA could be an emergency fund. You could use a TFSA if you have tuition set aside for a specific semester. You could use a TFSA to save for vacation. You can use a TFSA to save for retirement. You could use it to save for buying a home, although a first home savings account would be a better option. You could use it to save up for a car. A registered retirement savings plan is the opposite of a TFSA. You get a tax deduction upon contribution, meaning you don't pay tax now, you delay tax until later. Because you're delaying taxes, your investments can grow faster. The limit is 18% of earned income, up to a cap that would apply to higher income earners, minus contributions to a pension plan through your employer. The limit also carries forward on an RRSP. An RRSP is better for longer term savings. Because you're paying taxes later, it's good for those who are earning a higher income now and expecting it to decrease in the future. So an RRSP would be ideal for somebody who was putting aside money for retirement. You can also use a spousal RRSP to split income with a spouse. So if your spouse is lower income earning than you, or you are the lower income earner, the person with the higher income can put money into the RRSP for the person with the lower income, further reducing taxes. RRSP also has programs where you can use it to buy your first home, although once again a first home savings account would be superior, and you can use it to go back to school. This would be for your own education, whereas an RESP would be for your child's education. Once again, as with a TFSA, you could invest in GICs, mutual funds, stocks, bonds, savings account. Comparing an RRSP to a TFSA, if there is no change in tax bracket, both plans will end up giving you the same amount of money. If your tax bracket increases in the future, a TFSA is better. If your tax bracket decreases in the future, an RRSP is better. With an RRSP, some people complain that you pay too much taxes. That is half correct. With an RRSP, you will pay more taxes. That is because you will earn more income.